An appreciation to the organizers, in particular to the Commonwealth Secretariat, UWI, and the Ministry of Foreign Affairs for inviting me to this conference on the future of the Caribbean. I know disruptive thinking is part of this conference, but I didn't know that having a vibrating stage was also part of it. So if you see us moving around on the stage, it's because for the first time ever, the stage is vibrating. For the next few minutes, I'd like to speak about an innovative financing source for the Caribbean that has never been truly considered. And that is in the context of much of what Gail has spoken about. When we look at the external financing resources that have come to the Caribbean over the last 20 to 30 years, what we've seen is a region that has grappled with lower aid flows, the dismantling of preferential trade arrangements for sugar and bananas, the delimit interventions related to money laundering, terrorism financing, of course, the global financial crisis. When it comes to aid flows, there's been a significant compression of development assistance as donors moved away from the Caribbean. Aid now accounts for about 2% of GDP, compared to 4% of GDP in 1990. And what we've seen is the emergence of some new non-traditional aid donors, such as China and Venezuela. And that has contributed to some stabilization of aid flows, but does not provide any significant promise as we move forward into the next decade. The other significant source of external financing is foreign direct investment, which is usually considered a very stable source of private capital. And that has grown rapidly in the Caribbean if you look at the numbers. But again, almost half of the FDI flows to the Caribbean have gone only to two countries, Trinidad and Tobago and Jamaica. And therefore, faced with this significant compression of aid, faced with weak and sporadic FDI flows, regional governments have resorted to private and costly capital to help fund or sometimes even close their funding gaps. And that has led to a significant debt burden for the Caribbean. As many of you all know, by now the debt burdens of many Caribbean countries have reached unsustainable levels. 6 countries now have public debt to GDP ratios in the range of 50 to 90%. And 5 countries now have public debt to GDP ratios that are beyond 90% of GDP. And this high debt, the low growth issue, it has turned out to be perhaps the most difficult economic challenge for the Caribbean, and particularly as we start to contemplate what happens in the context of the Sustainable Development Goals. At the same time, for the region, we've noticed a major change in external financing, and that is remittances. Remittances have become an important and growing source of non-traditional external financing for many countries in the Caribbean. In 2013, the Caribbean received more than $4.5 billion in remittances, and that's about 6% of the region's GDP. And what is even more important is that the remittance flows are now far greater than aid flows and foreign direct investment flows. And for a few countries, remittances have actually become a significant lifeline. In Haiti, remittances now account for 21% of GDP. In Jamaica, 15% of GDP. And in Guyana, 11% of GDP. So what has happened in terms of the size and the composition of external financing for the region is basically a compression of aid, sporadic FDI, or mainly concentrated in a few countries, external debt that has ballooned and nor reaching unsustainable levels, particularly in the Eastern Caribbean, and remittances as a new source of finance. And as Gail said a few minutes ago, when we start to look at the Sustainable Development Goals, the immediate question is, where will the money come from? Because there are few promises of additional public resources, and therefore private capital has to play a greater role in financing the Caribbean's future development. But where will that private capital come from without leading to additional debt that is crippling many Caribbean economies? And therefore the region has to explore what we call some innovative sources of financing. And one of those sources is its diaspora. The Caribbean has a large, highly educated diaspora that represents a potential alternative source of financing. At the Central Bank, we've been engaged in a major study on the Caribbean diaspora, and our estimates place it at 25% of the region's current population. That is, we now have at least 4 million people that we can consider to be part of the Caribbean diaspora. And our preliminary estimates place the annual savings of the Caribbean diaspora at just under US $20 billion, or about a quarter of the region's GDP. And that therefore is a very substantial pool of capital available for tapping into. Diaspora savings are of course highest for countries where the migrant population is obviously very high. So in Jamaica, the latest estimates suggest the diaspora savings are around 6 billion US, or 42% of the country's GDP. In Haiti, 4.7 billion US, or 56% of GDP. In Guyana, 2.3 billion, or 77% of GDP. In Trinidad and Tobago, 2 billion and 7% of GDP. And in Suriname, just over 1 billion US dollars, or 22% of GDP. Most of these savings, of course, are invested in the host countries of the diaspora, especially the US, Canada, the UK, and given the recent work we've done, the Netherlands, which is the particular link between Suriname that I'll talk about in a little bit. Therefore, Caribbean governments have an opportunity to tap into these substantial resources. But why would a government want to issue a diaspora bond? Well, there are several advantages. First, the demand for a diaspora bond is likely to prevail regardless of economic circumstances. And in particular, in difficult times, you will find the diaspora would be more willing to provide financing because patriotism is a fundamental feature behind diaspora bonds. And the experience looking at two countries in particular that have been very successful at doing this, India and Israel, shows that a diaspora investor would be willing to buy a diaspora bond at a much lower interest rate than the rate demanded by foreign investors, and that is called a patriotic discount. At the same time, for those countries concerned about downgrades by the credit rating agencies, the development of a diaspora bond market can actually help improve a country's sovereign credit rating because it is now providing an additional source of financing, an additional external buffer to the country's reserves. And diaspora bonds can be structured in particular ways, especially if a country starts to run into balance of payments problems. It can structure a diaspora bond to actually make the payment not in US currency, but in local currency. And at the same time, you will find that diaspora investors gain satisfaction from knowing that they are contributing to the economic development of their country of origin, and especially if the bond is being used to finance a specific project in which the diaspora community has a special interest. Based on the research that we've done, there's a particular channel that somehow has not been fully explored, and that is the Diaspora Remittances corridor that exists between the Netherlands and Suriname. Suriname, as many of you know, is the smallest country in South America, and it has emerged from a long period of economic instability, and it now has a very favorable macroeconomic outlook. What has been important is that in 2010, the traditional aid flows that came from the Netherlands to Suriname, which is popularly known as the Dutch treaty money, came to an end. And that was the largest source of aid flows to Suriname. And Suriname now has to find alternative sources of financing if it has to continue on its particular development path. And what we are seeing is that Suriname has a large diaspora community in the Netherlands, around 190,000 persons, or the equivalent of nearly 40% of Suriname's population is in the Netherlands. And the annual savings of the Surinamese diaspora in the Netherlands is quite significant. Our estimates place these savings at around US $1 billion, or about 1/5 of Suriname's GDP. And those savings could finance 5.5 times Suriname's current external current account deficit. Therefore, there's a strong case for Suriname to look at the possibility of structuring a diaspora bond to target its diaspora in the Netherlands. Of course, we all know Suriname has an sub-investment grade rating from Standard & Poor's. And if it would have to issue a sovereign bond in today's climate, it would have to issue that bond at least 7.5%. But if Suriname were to obtain a partial risk guarantee from, say, the World Bank's IFC or from IDA, it could then raise the rating on these bonds to about investment grade and provide a yield of about 5%. So compare 5% to what a typical savings deposit rate is right now in the Dutch banks, which the highest rate right now is about 1.5%. And that shows you a massive incentive. But it also shows you the level of the patriotic discount that Suriname could enjoy, which is at least 250 basis points. And many of a diaspora bond for Suriname could therefore be used to target specific projects that the government considers priority areas, and many of those projects are very similar to what has been enumerated in the Sustainable Development Goals in areas such as agriculture, energy, infrastructure, social protection, and transport. Therefore, apart from Suriname, there are other countries such as Guyana, Haiti, Jamaica, and Trinidad and Tobago that offer strong potential for looking at a diaspora bond as a source of external finance. And as I end this presentation, I just want to leave with 3 key messages. 1, diaspora bonds at the end of the day offer Caribbean governments a very stable and affordable source of external finance. We need to start thinking about tapping into the Caribbean diaspora community for external financing. Secondly, despite the impressive size of the potential market for Caribbean diaspora bonds, no Caribbean country